Hi, Ken Boy with Accounting Accidentally. This video is called Wicked Movie Fans and Interest Rate Announcements. I had a chance to see the movie Wicked over the weekend. I thought it was a pretty good movie, and I noticed that the theater was packed. In fact, my theater had multiple screenings going on at the same time. All the screenings were packed. Lots of kids, lots of families. So this is from Forbes. Wicked charts massive weekend, third biggest U.S. premiere of 2024, breaking the Broadway film record. So this was posted right around Thanksgiving time. And it said biggest opening weekend ever for a film based on a Broadway musical. So tremendous interest in Wicked, and it's similar to something that gets tremendous interest in the stock market, which is any big changes or announcements related to interest rates. Start off on an understanding of interest rates, inflation, and other concerns. Let's talk about bond prices and bond yields. This is a good starting point. So bonds trade in the marketplace just like stocks, and the price of a bond can change. Many people don't realize this. Here's an example. Assume IBM issues a AA rated $5,000, that's the face amount, 6% 10-year bond outstanding for 10 years at par or $5,000. Each year, the investor earns 6% on $5,000 or $300, and that never changes for the life of the bond. That's stated on the face of the certificate, it doesn't change. Now let's assume interest rates increase. If comparable corporate bonds, say another corporation has a AA rated bond, can now be issued at 8%, the 6% bond declines in value. Why? Because if investors can buy a new bond at 8%, owning a bond at 6% is less interesting. So what will happen is the 6% bond's price will go down so that the total return, interest plus saving $200 on the price, makes the bond more attractive. So that's bond prices and bond yields. Now let's go on specifically and talk about interest rates and inflation. And the question, why does the Federal Reserve increase or decrease borrowing rates, which they have the power to do? Well, first of all, let's define inflation, the overall increase in retail prices over time. And you can think about a grocery cart, because literally what's happening is that the same standard amounts that are in a grocery cart that we buy all the time, milk, bread, eggs, etc., that gets priced every month and is a tool, along with others, to figure out what's happening with inflation, the overall increase in prices over time. Prices also have to do with supply and demand. If a customer is willing to spend more for the same amount of goods, we're going to the grocery store and buying the same stuff, but we're willing to pay more because we have more money in our pocket, prices increase, which is inflation. So the reason that the Fed may consider higher interest rates is it slows demand. Less demand, prices are less likely to increase. That means less inflation. So now that we've laid that groundwork, let's go to CNBC's article and talk about what actually happened yesterday, the day before I recorded this. The Fed cuts rates by a quarter point. It indicates fewer reductions ahead. So they are cutting interest rates less than they said they would. And specifically, the Federal Open Market Committee, which is a function in the Fed, cut its overnight borrowing rate to 4.25%. So the rate at which banks can lend to one another is the most important rate, because that rate has an impact on everything else. So if you're borrowing money from Bank America, the rate that Bank America can borrow from other banks, that starts the whole lending process. Okay. Why did this happen? Well, as widely anticipated, they cut it back to a level where it was in December of 2002. Here's the reason why they're cutting less. They're cutting less because they think they need to do this to control inflation. Inflation is creeping up, they think. If inflation creeps up, interest rates need to stay a little higher to prevent more inflation. The original intent was inflation's really going away, we can cut rates quickly. Now what's happening is inflation is sort of stalling. Therefore, the Federal Reserve believes they've got to keep interest rates higher to keep inflation from going even higher. So this is a strategy to control inflation. So the takeaway here is two things. If you're an investor, bond prices change, and changes in interest rates have an impact on your bond investment, and also that the Federal Reserve is making these changes as a tool to combat inflation.